All right, hour number 3, Rush to Reason, Denver's Afternoon Rush, KLZ 560, and we're welcoming back, I should say right now, David Stryzewski from the Sound Planning Group, CEO, I should say, of Sound Planning Group. David, how are you today?
Hey, doing fantastic, John. Yourself?
I should say this evening. I'm doing great. So, U.S. recession, is it delayed, derailed? What are your thoughts?
Well, it's been delayed, but I don't believe that it's been derailed. You know,
Agree.
The world economy right now, slowing. We got Germany in recession, Japan on recession, UK and Canada facing significant housing issues. And then, of course, China and their housing market is actually the largest economic sector in the world,
right.
And it is under massive pressure right now as their banking is falling apart and everything's in trouble. So no, there's a lot of reasons why we can be pointing towards a recession here in the future. But the biggest part of it comes down to the consumer. And so the consumer is just going into 2024 much weaker than they have before.
Agree.
Over $1.2 trillion in debt. We saw over 50% gains on this buy now, pay later stuff here over Black Friday. And, you know, the families today are not feeling 3% inflation like the recent number has.
No, that's right. No, they're not. But despite what the White House says, it's not just, as you know, 3%. It's like 9 plus 9 plus now 3, which somehow the White House doesn't understand math. Yeah,
exactly. According to Truflation, who I like to use, since January of 2020, we're looking at 23.05% actual loss in our buying power.
There you go.
Inflation that we have now received.
So I think my 9, 9, and 3 is pretty close to that, by the way.
There you are.
I laugh, and David, you know this. I mean, I'm a non-college educated individual. I was lucky to get out of high school. Yes, I've been self-employed since I was 22, but I don't have the brain power that a lot of those folks in the White House do. I'll be the first to say that. But yet, just a moment ago, I explained in pretty simple math what you backed up. This isn't that difficult.
No, this isn't that difficult. In fact, let me just share an idea that's kind of an uncommon one, because a lot of people have been thinking, on this idea of recession. Why wasn't 2023 this year of recession? And so the reason for that was because of the tremendous government spending was done in PPP loans and then the employee retention credit loans. But that all dried up now. When you give $1.2 trillion to business owners like you and I, and who have the highest propensity to spend money, well, guess what happens? You're going to spend all that money.
You kept people in, which, those programs were designed to keep employees employed and keep things rolling along and help businesses expand, which a lot did. And, again, there was a lot of fraud in that. That'll probably be another topic for another day. But, David, a lot of individuals like you and I did exactly what that was intended to do. And we, in a way, kept things afloat. That's not continuing.
No, it's not continuing. In fact, they're going to be investigating something like 600,000 claims that were just even brought in here over the last quarter, as whether they're fraudulent or not. And so, this isn't great. We don't have a great track record with these programs, but ultimately, it's caused our economy to grow. And
really quick, in my opinion, there were, again, you tell me if I'm on the right track. There was a couple of things that caused it. You mentioned one. The other thing is people built up some savings during COVID because they had other things coming in. They had some checks from the government also coming in. They weren't spending as much. They weren't traveling. They weren't going places. So they had sort of this savings, if you would, built up. That was also spent down. They're now working off of credit cards. It's the highest ever. And I read something the other day to all of my listeners to where even this particular Christmas season, 1 in 3 people aren't going to exchange gifts as adults.
Wow, that's amazing. Well, here's what I'd say about the consumer. Those credit cards, unlike a mortgage, which you could repossess a house or a vehicle that could be repossessed, those are unsecured lines of credit.
Right.
And so here's the worst case scenario, in my opinion, and it seems like it's headed this direction, and that is we get through this Christmas season, this holiday season here, and we're going to spend some money. Most people do. And, you're going to get to January of 2023. So just this last January was the first time that people didn't pay off their credit cards.
Right.
And so now we're looking at 24% APRs
That's right.
on that.
That's
if you're trying to come up with $1,000 a month, you're going to find yourself pretty devastated at some point. And I think you're just going to give up. So if you had 30,000 of a credit limit and you're at 20 today, do you just stop? Heck no. You're going to max that thing out
Go
out with a bang.
That's right.
Ultimately leaving these banks and these credit card companies holding the bag here at the end. So I think this thing could deteriorate very quickly if this set of circumstances go forward like that.
Okay, a couple of questions. I've got a question from a caller, but let me get to something I wanted to ask you first. And I don't have a crystal ball, but my prediction is I agree with you. I think things are going to get really dicey as we move into 2024. There's an election coming up. The Fed knows that. People can say the Fed's neutral all they want. I don't believe they are. I feel, and you tell me if I'm right or not, but I see coming in 2024 2 quarter-point lowering of the interest rate and another half point giving us a point in the first 6 months. Am I right or wrong?
Okay, if you're right, which I don't have a crystal ball, okay, either, if you are correct, then there's going to be significant deterioration to our economy. And the reason for that is because the U.S. dollar today is in horrible shape.
Right.
And one of the reasons why our dollar has increased so significantly here over the last couple of years was because Powell showed up strong on inflation.
Right.
And so he's saying, okay, I'm going to be, tough on this, and we're not giving in, all the tough stuff. Powell's a dove. He is not actually the hawk that he says that he is, and he portrays on TV sometimes. I think that he is going to be quick to drop rates, and I do think that inflation's come down very significantly. The near term stuff, again, the cumulative is 23%.
Right, that's right. That's right.
That's what's killing everyone. Why we have?
But it's in the past. It's done. It's over with. You can't fix that.
Well, unless we can really get our economy moving.
And you're leading into where my thought is, I think, as well, David, which is to your point a moment ago about us as business owners. We don't spend money when rates are high because we're not going to invest and borrow and do things we normally would. So in my opinion, the only way they try to get things ramped back up after what you said, I do believe you, is going to happen, they have no choice but to lower rates, which, again, doesn't help the dollar.
No, it doesn't. And I think, especially with Moody's looking at downgrading us because of the political unrest and, of course, the excessive deficit spending, $2 trillion we missed our budget by. I mean, $1 trillion used to be a big number a long time ago.
Right.
But I think 2024 is a year where we're going to start turning our attention to balance sheets. And the balance sheets of many corporations in this nation are way off right now. In fact, here's the thing to note. If your listeners want to be looking out for something, take a look at high yield bonds. In other words, junk bonds. That's the fancy word for them, high yield, lipstick on a pig.
Okay.
These are the most dangerous investments I could possibly think of right now for this reason. When money was cheap and prevalent, they could borrow at 4%. These are companies that can't borrow in basic normal ways. Today, they're spending in excess of 10% in order to get new credit. How on earth are they going to do this? Because they either have to pay it off or they need to refinance that debt, which is going to become very difficult because it's going to be a lot more expensive and therefore eating up all the profits and the whole reason why you're in business.
Right.
But the last point to this is that I think that what you're going to end up seeing is a lot of very strategic defaults. That's a term, strategic defaults that I'm using right now. Basically, you can either completely shut your doors or you could restructure with, hey, a Chapter 11, and you say, you know what, I'm going to keep my most profitable locations. I'm going to jettison the difference of those, the ones that aren't working out as well, and then kind of right-size the organization. And what ends up happening is if you're a bondholder, and this is just normal corporate bonds. If you're a bondholder and they file bankruptcy, this is literally one of 5 ways that we can lose money in bonds, but it's the most devastating.
Right.
We get nothing.
That's right, zero. That's right, zero.
So the most conservative, safe way that we're told inside of traditional portfolio management is to put our money inside of bonds right now. And I'm just going to tell you, whether it's the junk bond market or just even the corporate market that has to metabolize all this debt, we're looking at like $1.5 trillion that needs to be metabolized right now because good CFOs 5 years ago lowered those interest rates and locked in new debt payments. But that 5 years is coming to roost right now.
True.
And I don't think that this is a very good sign for where we're headed.
All right. So given all of that and some of what you and I have been talking about, what do people do? What's a good strategy investment-wise for them?
Okay, so the goal for investing is to ride bull markets and to tame the effects of bear markets. And by the way, Riding Bulls and Taming Bears is the name of my new book that's going to be coming out
nice.
Here, first part of the year.
Nice.
Yeah. So we need to be diversified, but I want to encourage people that what got us here is likely not going to be what keeps us going into the future, because the big macro effect here is that the 40-year credit cycle, where we could just reduce rates every time we had a problem, that's over. Powell flipped it. It's going to be up higher, and even if we drop 1%, yeah, that makes a difference, but we're in a higher for longer economy. We're not going back down to 3% interest rates on mortgages.
I agree with you on that. I agree.
So we have a commodities-based economy that's going to need a lot more things like copper, uranium, lithium. You know, I'm a massive fan of gold and silver, and if you look at what has happened here in the gold and silver market here today, we just had it regress from what was the highest highs here just a few days ago. I believe that is a gift. Gold and silver are going to be going through the roof. Almost any economist that I speak to right now recognizes that this is a huge opportunity. But for people that are looking to be diversified, allocate, how do we do it? We need to be more active in our money management. We need to use individual names as opposed to sectors and ETFs and mutual funds, because we want to find the best fundamentals, the companies that have the best balance sheets, the best CEOs, that are the best in class. And so, you know, it takes a lot of work to figure these things out and to identify these strategies. But ultimately, you know, that in combination with some hedging strategies that give you the ability to ride bulls and tame bears, or, you know, be anchored when things really get bad. What if you could get zero in some of your portfolio, and then you can feel a little bit better, you know, taking more risks, swinging for the fences here. And so my firm likes to do that with a tool that is commonly not understood to be a bond alternative, but it absolutely is, and that is called a growth-oriented fixed indexed annuity. It's actually an insurance contract. And I'm telling you, if you look at what these contracts are able to do right now relative to interest rates and everything else, if we're looking at the 10-year Treasury of the United States, it's a 4.12% return. Okay, so 412 we call the risk-free premium. People that are investing in the S&P 500 blindly right now, they need to understand something, and that is the price-to-earnings ratio. The PE ratio of the S&P 500 is 30.9%. And what that means is it takes you 30 years to get your money back.
Okay.
Well, I can just do some simple math here. If I say on the short end of Treasuries at 5%, and I just hold that for 20 years, that's 100% of my money back. Or I could buy the S&P 500, and hopefully in 30 years, if earnings stay the same at this perfect moment that we find ourselves right now before the storm, you know, then we're basically settling for a 3.22% return. I don't think that's good math here. And I think people are going to wake up and they're going to find themselves in a world of hurt. But if I can make this last point on that, do not forget about tax diversification. With higher levels of debt, with our nation going into more of a challenge, tax diversification becomes more important. We got just a few days left in the end of the year to maximize your Roth contributions or conversions. We just got 3 tax returns to get the Tax Cuts and Jobs Act opportunities that are available. And by the way, this is the single greatest moment for people to reduce or eliminate taxes in their retirement lifetime. And it's here, and it's going away in 3 tax returns. And so if they don't take action here today,
good point.
You know, forever hold our peace.
Good point. All right, last question. I don't know if you have an answer to this or not. A caller asked, when Biden met with China's leader in San Francisco, is it true that he pledged significant financial aid to China? I've not heard anything along those lines, so I can't answer.
I didn't see anything about pledging significant aid. I did see a few cheap little things, like Xi was saying, hey, we're going to do something about fentanyl. But what most people don't realize is that fentanyl, if you just change one little point of it, it can be changed 1,000 different ways and still be as potent and still be as deadly.
I see.
President Xi and China are absolutely waging World War III, in my opinion.
True.
They're the culprit behind it. They're in very difficult economic conditions right now. And, you know, I don't think that they're anyone's friend at this point.
Agreed.
They're in it for themselves.
I agree. Thank you. I appreciate that. David, as always, how do folks find you? And when the book comes out, we'll have you back when that comes out, by the way. But in the meantime, how do they find you? Yeah,
website is myspg.com. And people are certainly welcome to go in there and take a look at videos and different things that we've done, even, you know, ping my office. And for those that are interested in sitting down, having a portfolio review, understanding what your options are and things that are available to you right now, you know, we do that actually at no cost. We're actually one of the fastest growing companies in America right now, according to Inc. magazine.
Awesome.
And we're pretty honored to be able to hold that reputation at this point. So, John, it's always a pleasure.
Always a pleasure as well.
And,
I appreciate it, David. Very wise. So thank you. Appreciate you very much. Have a great evening, David. We appreciate it very much. CEO of Sound Planning